Essential in this market.
We hear a lot of factories are moving outside of China. Have you considered this?
We are not really looking at market outside of China. We are based in China, we are based in Wenzhou, and we are going to serve, and we serve in the past, all the top-level customer. Our customer are really willing to have a high-quality product, and they are not so willing to receive only lower cost production. This means that we focus a lot of attention in the quality of the product, and we don't need at this day to find alternative source for finding lower production cost.
As I mentioned before, we moved our production, part of our production out of China to be able to compete on the global market. And this shift is not a small thing, since about 40% of our production has moved out of China within 2 years.
Who are China's biggest threats in terms of grabbing market share?
We've seen in the last 2 years a greater shift to countries like Vietnam, the second largest exporter of apparel to the United States, and I mean that's a phenomenal growth for Vietnam in the last 5 years. No one would have expected it would have grown so quickly, but because of quota uncertainties in China, because of cost of labor in China, people have moved to Vietnam.
As far as I can see now, I would say India, Bangladesh and Indonesia would be the three main sources at this point. Bangladesh is an attractive place today for several reasons. Number one, the currency linked to the US dollar, which means that the depreciation of the US dollar has increased their competitiveness by about 20%. We also have a favored treatment from European countries on all imports from textile import from Bangladesh. They have no duty compared to about 10 to 12% for Chinese imports. And the last thing would be the export tax that is imposed on Chinese export that we don't have in Bangladesh. By moving to Bangladesh, we are about saving 40% on our sourcing cost.
Alex, Benoit and Lelio, thank you for being with us today.
Okay, thank you, Sunny.
Thank you, Sunny. It was my pleasure.
The chemical industry is an important link in the global supply chain, providing numerous value-added products and services. Russell Barron has looked further into the challenges currently facing the industry, focusing on one key player, Dow Chemical.
With demand for chemicals in China expected to double between 2002 and 2015, the country's chemical industry represents an attractive opportunity, greatly facilitated since China joined the World Trade Organization at the end of 2001. As many multinational companies struggle amidst a volatile global economy and finding the right plan for China, the Dow Chemical Company's China strategy appears to be paying off. So far, Dow has invested over $500 million in Greater China and earmarked another $400 million for new manufacturing and R&D facilities. Dow has had a long presence in China, first arriving in the 1930s and then officially entering the mainland in the early 1980s.
In the 1980s, mainly we are competing with multinationals. Okay, you can name it as mainly multinationals from Europe and from the United States. And as we evolve, then we have local Asians coming in, mainly the Japanese. And then later on you have the Koreans. And then now we are facing competition from local Chinese competitors as well as competitors from the Middle East.
In line with China's ongoing push up the value chain, away from low-end consumer products to more sophisticated and higher-end products, the competitive landscape has changed.
The Chinese government is encouraging value-added manufacturing rather than low-value assembly or piecework manufacturing, and chemicals fits very well with this.
The chemical giant, which prides itself on its commitment to human progress through the harnessing of science and technology, has big plans for China.
China is currently our third largest global market, and we expect within 10 years it will be the second largest, surpassing Germany, and within 20 years it will become our largest global market, surpassing the United States.
With an eye to the future, many multinationals are shifting their global R&D investments to China.
Globally, Dow spends more than $1 billion a year on research and development.
When Dow opens their new facility in Zhangjiagang, over 600 engineers will be doing research for the global market. But are Chinese companies offering real competition?
If you look at from the commodity product perspective, I think the Chinese are as good as making the same product as most of the multinational. I think the thing is that you look at the market-facing end, which is the more value-added end. I think because this is all technology-driven and R&D driven. So this is where the Chinese competitor is, I would say, a little bit lacking.
Dow is a good example of a company with a clear long-term plan and execution strategy for China, which, as some companies have found out, is necessary for success in such a dynamic market.
To be number one, it doesn't mean that you have the number one sales in the world. You basically need to have the capability, the competency, and also the asset in place to be in that number one position.